Title: Healthcare Financial Market News from Today, Sector Update and Analysis. Disclaimer: this report is for informational purposes only. It is not legal, medical, financial, or official advice. All content is news and analysis, not guidance. Please do not treat any of the following anecdotal stories as advice. Script: Hello and welcome. Today we're bringing you a deep dive into the latest developments in the healthcare financial sector *, with expert analysis on how they're shaping the stock market and industry landscape. We have *10 major topics to cover, each unpacked in detail with 7 key subpoints to give you a comprehensive view. Let's get started with our first story of the day. 1. Pharma giants ride new drug waves. Leading pharmaceutical companies are surging on the back of breakthrough therapies. First, a weight loss drug boom is redefining big pharma fortunes. Major players like Novo Nordisk and Eli Lilly have seen their stock valuations soar as groundbreaking obesity medications gain mainstream adoption. These GLP-1 class drugs, initially for diabetes, have sparked enormous demand for weight management, a fast-growing market. Second, competition is fierce. Novo Nordisk just launched a multi-month subscription program for its popular obesity drug Wegovy, aiming to lock in patients with lower, predictable monthly costs. This innovative pricing model, offering 3, 6, or 12-month plans for injections and pills, is designed to improve patient adherence and compete with Eli Lilly's rival treatments. Third, Eli Lilly holds a dominant U.S. market share in these weight loss therapies, with around 60% of prescriptions, pressuring Novo's 40% share. Lilly's own GLP-1 drugs, like the diabetes drug Ozempic and weight loss branded Zepbound, have transformed the company's growth narrative. Investors are bullish that these drugs could become blockbuster franchises, driving multi-billion-dollar revenues annually. Fourth, beyond weight loss, Big Pharma is buoyed by new Alzheimer's treatments. For instance, Eli Lilly's breakthrough Alzheimer's drug, approved recently after years of research, and the launch of Biogen and Eisai's therapy have ushered in a new era for neurodegenerative disease drugs, offering hope to patients and boosting share prices for the companies behind them. Fifth, pharmaceutical firms are rapidly scaling up manufacturing and supply chains to meet the explosion in demand for these novel therapies. Novo Nordisk, for example, is investing heavily in production capacity and partnerships to ease recent supply shortages, knowing that fulfilling demand is critical to sustaining its stock momentum. Sixth, analysts note that these successes are turning pharmaceuticals into a market-leading sector. Big pharma stocks are now seen as both defensive and growth-oriented, benefiting from stable healthcare demand and innovation-driven upside. This positioning has attracted a wave of investor interest in healthcare equities as economic uncertainties persist. Seventh, other companies are racing to catch up, from smaller biotechs exploring their own metabolic treatments to major pharma rivals pivoting resources into obesity and Alzheimer's research. The arms race in new therapies underscores a broader trend. Innovation is now the key driver of market valuations in healthcare, and leaders with clinically effective drugs are reaping significant financial rewards. 2. Biotech sector rebounds and breakthroughs. After a period of turbulence, the biotechnology industry shows signs of recovery on the back of scientific breakthroughs and revived investor confidence. First, biotech stocks, which struggled in recent years, are mounting a comeback as clinical successes restore optimism. For example, a small oncology biotech recently saw its shares skyrocket following a breakthrough phase 3 trial for a novel cancer therapy that significantly improved survival rates. Such successes have reminded investors of biotech's potential for outsized gains when drugs succeed. Second, even historic milestones in cutting-edge medicine are boosting the sector's credibility. Late last year, the FDA approved the first gene-editing therapy for a genetic disease, a momentous event that validated years of research in CRISPR technology. This approval not only propelled the stock of the companies behind it, but also lifted sentiment across the biotech field, as it demonstrates that high-risk, high-reward science can pay off. Third, the financing environment for biotechs is cautiously improving. After a drought, we are seeing more biotech IPOs and secondary offerings being attempted, albeit selectively. Investors remain more discerning, favoring companies with strong data or de-risked assets. But the fact that capital is beginning to flow back into biotech R&D is a welcome change. Fourth, large pharmaceutical companies are also playing a role in the biotech revival by forming partnerships and strategic alliances. Pharma giants flush with cash have inked licensing deals and collaborations with smaller biotechs, providing needed funding for startups while bolstering big pharma pipelines with innovative candidates. Fifth, rising M&A speculation is further lifting biotech valuations. With many pharma blockbusters facing patent expirations before 2030, big drug makers are on the hunt for acquisitions to replenish their future revenue streams. This dynamic, which we'll explore more in our M&A section, has caused investors to bid up promising biotech targets in anticipation of potential takeovers. Sixth, the biotech sector's recovery remains uneven. Not every company is thriving. Some firms with less compelling data or without near-term catalysts still struggle to attract investment. This divergence, winners with solid science versus laggards, means the biotech market is increasingly bifurcated, requiring careful stock picking. Seventh, nonetheless, the general outlook has brightened. Biotech indices have begun to climb again, and there's a sense that the sector's worst slump is over. Analysts caution that macroeconomic factors, like interest rates, which impact speculative investments, still matter, but the fundamental driver, robust clinical data, is back in the spotlight and helping to restore faith in biotech as a growth engine for the healthcare market. 3. M&A surge reshapes healthcare industry. A wave of mergers and acquisitions is sweeping through the healthcare sector, consolidating companies and reshaping competitive dynamics. First, big pharmaceutical companies are aggressively acquiring innovative biotechs, fueling one of the busiest deal environments in years. Just recently, one pharma giant agreed to buy a biotech focused on rare diseases for around $12 billion in cash, a move designed to diversify the acquirer's pipeline ahead of looming patent cliffs on its older drugs. Deals of this scale highlight how major players are willing to pay top dollar for promising drug candidates to sustain growth. Second, the medical technology and diagnostics space is also seeing transformative deals. In a headline-grabbing transaction, a consortium of private equity firms is taking a leading medtech company private in a deal approaching $20 billion, marking one of the largest buyouts in the industry's history. Taking this established medical device maker off the public market is expected to infuse it with capital for R&D and focus on long-term innovation away from quarterly earnings pressures. The move also reflects bullishness by private investors on the steady demand and cash flows in specialized healthcare niches like women's health and diagnostics. Third, vertical integration deals are blurring traditional healthcare lines. For example, a major hospital system recently acquired a large multi-state physician group from an insurer's health services division, expanding its reach into outpatient care and tens of thousands of new patients. At the same time, an insurer-owned physician network merged into a regional health system, showing how providers and payers are forming tighter integrated networks to coordinate care and reduce costs. These moves aim to deliver more patient-centered services, but they also increase the market power of consolidated healthcare entities. Fourth, private equity continues to target healthcare beyond medtech, particularly physician practices, urgent care clinics, and hospice chains. Investors are attracted by healthcare's stable demand, and they see opportunity to roll up fragmented providers into larger platforms. While this brings capital and efficiency to some practices, it also raises questions about cost-cutting and quality if profit-driven models dominate patient care. Fifth, in the pharmaceutical and biotech arena, analysts expect the M&A momentum to continue throughout the year. Companies with strong balance sheets would rather purchase proven drug candidates than invest solely in their own lab research, given the urgency to replace revenues from drugs losing exclusivity. This environment has made biotech sector watchers identify the next likely buyout targets, creating speculative rallies in smaller biotech stocks whenever rumors swirl of potential suitors. Sixth, regulators are paying attention to this consolidation wave. Large mergers, especially involving hospital systems or insurance companies, face scrutiny from antitrust authorities concerned about reduced competition and higher prices for consumers. Some deals have seen delays or required divestitures to win approval, but thus far most healthcare deals have managed to clear regulatory hurdles. Seventh, the net effect of this M&A surge is a rapidly evolving industry landscape. Bigger, more diversified healthcare conglomerates are emerging, aiming for synergy and scale. For investors, the consolidation can create winners and losers. Combined companies may enjoy enhanced market power and cost efficiency, while those left out could struggle to compete. It's a trend that is fundamentally altering where value lies in the healthcare sector. 4. U.S. policy shakeup and regulatory moves. Significant policy shifts in Washington are reverberating across the healthcare financial landscape, forcing companies and investors to adapt. First, the U.S. government has enacted historic measures to rein in drug prices, fulfilling long-standing promises to address medication costs. Beginning this year, Medicare is exercising its new authority to negotiate prices on a set of high-cost prescription drugs for the first time. This move, part of legislation passed earlier, directly targets some top-selling medications and is expected to cut costs for seniors but trim revenue for pharmaceutical companies over time. Investors have responded by closely examining drug makers' portfolios to gauge which companies face the biggest hits from negotiated pricing and which are relatively insulated. Second, mounting pressure on pharmaceutical pricing has also prompted more aggressive use of trade policy. The current administration in Washington finalized plans to impose steep tariffs, up to 100%, on certain imported drugs from manufacturers that do not bolster domestic production or agree to local pricing concessions. The White House frames this dramatic step as a matter of national security to ensure drug supply chains aren't overly dependent on overseas factories. Pharmaceutical companies targeted by these tariffs could see higher costs or be forced to shift manufacturing stateside. However, economists warn that if fully enacted, such tariffs might cause price spikes for consumers in the short term as import costs surge, a scenario that leaves investors and healthcare providers anxious about near-term market disruptions. Third, in a bid to modernize and innovate health policy, the administration has also moved to accelerate approval pathways for emerging therapies, notably in mental health. By executive action, regulators have been directed to ease restrictions and fast-track psychedelic drugs like MDMA and psilocybin for treating PTSD and depression in controlled settings. This policy pivot, once unthinkable, has been met with optimism by biotech firms specializing in psychedelic therapy, some of which saw their stock values climb on hopes of a clearer path to market. Fourth, regulatory developments extend beyond pharmaceuticals. Authorities are also focusing on healthcare cost transparency and competition, implementing rules that require hospitals and insurers to publicly disclose prices. As these transparency rules gain teeth, they could shake up competitive dynamics by making it easier for employers and patients to shop for value, though the full market impact is still unfolding. Fifth, Medicaid funding and coverage policies are under the microscope in 2026. The wind down of pandemic-era expansions means millions are at risk of losing Medicaid coverage, prompting intense policy debates at the state and federal levels. Insurance companies that manage Medicaid plans are watching closely, since enrollment shifts could affect their bottom lines. Meanwhile, some states are experimenting with new models to contain Medicaid costs, decisions that can influence healthcare providers' finances in those regions. Sixth, in the backdrop lies an upcoming election cycle. Healthcare remains a hot political topic, with debate raging on issues from drug affordability to insurance reform. While no sweeping overhaul, such as a public option or single-payer system, appears imminent in this divided climate, proposals and political rhetoric alone can jolt healthcare stocks. For example, a suggestion of stricter price controls or changes to Medicare Advantage might send related stocks swinging. Investors are thus attuned to the evolving political discourse as part of their risk calculus for healthcare investments. Seventh, on the regulatory front outside the U.S., the European Union is rolling out a new joint clinical assessment process to standardize how new drugs are evaluated across member countries. This change isn't about pricing directly, but by harmonizing clinical value assessments EU-wide, it could indirectly impact pricing and access negotiations country by country. Global pharma companies are having to adjust their market access strategies to this new paradigm, ensuring evidence packages meet Europe's unified criteria to secure timely reimbursement, a critical factor that will influence their European revenue streams going forward. 5. Health insurance industry developments. The nation's insurance giants are adapting to economic pressures and policy changes, with financial implications for the broader healthcare market. First, health insurers have reported strong profits recently, but rising medical costs are beginning to bite. After a period of unusually low claims during the pandemic, patients have returned for delayed care, and inflation in medical services, from hospital procedures to prescription drugs, is driving up insurers' expense payouts. In response, premiums are on the rise. Employer-sponsored family health plan premiums jumped around 7% this year, roughly twice general inflation, hitting small businesses and workers' wallets. These rate hikes help protect insurers' margins, but also stir political scrutiny about affordability. Second, one of the biggest growth areas remains Medicare Advantage, privately managed Medicare plans, which continue to enroll more seniors each year. Major players like UnitedHealth, Humana, and CVS/Aetna have aggressively expanded their Medicare Advantage offerings, seeing a lucrative and stable revenue source. However, regulators have moved to crack down on excess payments in this space by adjusting risk scoring formulas and auditing for overbilling. Investors are watching how these rule tweaks, which effectively trim government payments, will impact the earnings of insurers heavily weighted to Medicare business. So far, diversified insurers seem positioned to absorb the changes, but it's a key area of focus. Third, vertical integration strategies by insurers are reshaping the landscape. Many large insurers now own pharmacy benefit managers, PBMs, outpatient clinics, or even physician groups, blurring the lines between insurance and care delivery. UnitedHealth's Optum unit, for instance, employs tens of thousands of physicians in clinics nationwide, and rival insurers are not far behind. These moves aim to control costs and funnel patients to in-network services, a strategy that can yield financial efficiency. At the same time, it raises antitrust eyebrows. Regulators and lawmakers have signaled concern that insurer PBM consolidation and insurer-owned providers might reduce competition and patient choice. Fourth, the insurance industry faces growing public pressure for transparency and fairness. There's momentum behind measures to curb surprise billing, which has already seen legislative action, to limit prior authorization hurdles, and to demand clearer pricing from insurance plans. While insurers publicly support value and transparency, they also warn that some overly strict regulations could disrupt their risk management. Nonetheless, the industry is gradually adapting. For example, some insurers are voluntarily simplifying approval processes or eliminating copays for certain vital drugs to improve their public image and comply with new rules. Fifth, on the business growth front, insurers are innovating products. We've seen new insurance offerings like virtual first health plans, where primary care is mainly telehealth, and plans integrating wellness incentives and digital tools to keep patients healthier and costs lower. Some insurers are dipping into offering subscription-like services for specific chronic conditions or partnering with tech companies to offer monitoring devices, reflecting a trend to differentiate plans beyond just network and price. Sixth, insurtech startups and competition. A few years ago, venture-backed insurance disruptors promised to upheave the market, but many struggled to scale profitably. By 2026, the traditional giants still reign, as some upstarts have been acquired or refocused. The big insurers are instead incorporating technology from these disruptors into their own operations, such as improved apps and data analytics, to improve efficiency and member experience. Seventh, investor sentiment toward the insurance sector remains relatively positive, as these companies have proven adept at maintaining profitability even in challenging times. Health insurance stocks are seen as somewhat defensive. They generate reliable cash flow, but they aren't immune to policy risk. The market keeps a close eye on any hints of regulatory shakeups, since changes to government programs or pricing regulations can quickly alter insurers' financial outlook. As things stand, insurers are navigating a delicate balance, passing on costs via premiums, investing in care integration for long-term savings, and lobbying to shape the rules under which they operate. 6. Hospitals and providers. Costs, consolidation, and care models. Healthcare providers, from big hospital systems to local clinics, are confronting significant financial challenges and opportunities as they adapt post-pandemic. First, hospital operating costs remain elevated, especially labor. Over the past couple of years, hospitals have grappled with a nationwide nurse staffing shortage that forced higher wages and reliance on expensive temporary staffing. Even as the crisis abates, labor costs are now permanently higher, squeezing hospital profit margins. Large hospital chains report that while patient volumes, surgeries, ER visits, etc., have rebounded close to pre-pandemic levels, margin recovery is lagging because payroll, supplies, and drug expenses have all climbed. Second, to cope with these pressures, hospitals are pursuing consolidation. Mergers between healthcare systems have accelerated, particularly among nonprofit hospitals which band together to gain scale and negotiating leverage. This consolidation trend is creating regional giants that can spread costs over more facilities and use their size to demand better rates from suppliers and insurers. However, it also draws antitrust scrutiny over potential local monopolies. Community advocates worry that too much consolidation could reduce patient choice and raise local healthcare prices. Third, hospital financial performance varies widely by geography and type. Urban and suburban hospitals with diversified service lines and higher privately insured patient mixes are generally staying profitable. In contrast, many rural hospitals and safety net providers face severe strain, with some on the brink of closure due to low reimbursement rates and dwindling populations. The closure of a rural hospital not only is a blow to local care access, but also can reverberate politically, increasing pressure on policymakers to offer support or incentives to keep essential facilities afloat. Fourth, providers are innovating with new care models to cut costs and improve outcomes. One such model gaining momentum is hospital at home, where certain patients receive acute-level care from home through remote monitoring and visiting nurses, reducing the need for expensive hospital stays. Early results show such programs, adopted by a number of leading systems, can maintain quality while saving money, a win for payers and potentially an extra capacity outlet for hospitals when beds are full. Fifth, technology is also permeating provider operations. Telehealth remains a core part of care delivery even after the pandemic emergency. Telemedicine visits have settled at a higher baseline than pre-2020, especially for behavioral health and routine consultations. Although reimbursements for virtual visits have in some cases been dialed back relative to in-person visits, providers with efficient telehealth platforms find it a cost-effective way to extend services and keep patient engagement. Sixth, value-based care arrangements, where providers are paid based on patient health outcomes rather than volume alone, are expanding. Major hospital systems and physician groups are increasingly entering into these risk-sharing contracts with insurers and Medicare. They invest in preventive care and care coordination to avoid expensive emergencies and readmissions. Financially, organizations that succeed in value-based models can reap shared savings, but those that don't manage costs well may incur losses, so it's transforming the skill set needed for provider management, blending clinical care with data analytics and population health management. Seventh, on the stock market side, the publicly traded hospital companies, like HCA Healthcare, Tenet, etc., have seen their stocks recover significantly from the pandemic slump as patient volumes recovered and new efficiencies took hold. Yet, caution remains. Investor optimism about growth is tempered by caution over labor costs and potential future pandemics or regulatory impacts. In short, the provider sector is stabilizing financially, but continues to walk a tightrope between delivering high-quality care and maintaining sustainable economics. 7. Medical devices and technology companies growing. The medical device and equipment segment, often overshadowed by big pharma, is thriving on innovation and returning procedure volumes, impacting financial outlooks. First, elective surgeries and procedures have fully bounced back, and that's good news for medtech companies. Firms that supply surgical tools, implants, like hip and knee replacements, and hospital equipment are seeing robust sales now that patients feel more comfortable getting non-urgent procedures again. For example, giants like Medtronic and Stryker have reported double-digit growth in certain product lines as operating room schedules stay packed and hospitals invest in modernizing equipment. Second, high-tech devices and robotics are at the forefront of this growth. Surgical robotic systems, advanced imaging devices, and minimally invasive surgical tools are in high demand by hospitals aiming to improve outcomes and efficiency. The push for precision medicine and safer surgeries means surgeons want the latest technology. Companies that offer innovative platforms, think next-generation surgical robots or AI-assisted diagnostics, benefit from both initial sales and recurring revenue from consumables and software. This advanced tech has become a key selling point in the medtech investment thesis, convincing investors that certain medical device firms have strong long-term growth prospects. Third, in a notable industry shakeup, private equity made a blockbuster bet on a top medtech firm recently, as we discussed earlier. The nearly $20 billion deal to take Hologic, a leader in women's health diagnostics and medical imaging, private is a sign that investors see undervalued assets in the medical device arena. Freed from public market pressures under private ownership, companies like this can focus on R&D in emerging areas such as early cancer detection and minimally invasive biopsies, which could unlock significant future value. This also suggests public markets may be undervaluing some steady but unspectacular medtech businesses, making them targets for buyouts. Fourth, supply chain improvements are aiding the sector. During the pandemic and the chip shortage that followed, many device makers struggled to source components like semiconductors, delaying production. By now in 2026, those bottlenecks have largely eased, component supplies have stabilized, and factories are running at capacity. This has enabled medtech firms to clear backlogs of orders and meet new demand more promptly, which is reflected in healthier revenue and earnings in recent quarters. Fifth, regulatory tailwinds are also present. Healthcare regulators, including the FDA, have been actively encouraging innovation by expediting approvals for devices meeting unmet needs through programs like Breakthrough Device Designation. And globally, there's movement to harmonize device regulations, which could simplify market entry in multiple countries. Still, the industry is mindful of patient safety concerns. For example, controversies around certain implants have prompted calls for stricter post-market surveillance, a reminder that with innovation comes the responsibility of vigilance to maintain trust. Sixth, medtech companies are exploring expansion into emerging markets to fuel growth as well. Demand for healthcare infrastructure and devices in Asia, Latin America, and Africa is rising, and firms are tailoring cheaper, robust versions of products for these regions. These global expansion efforts could become a significant revenue contributor over the next decade and are often highlighted in corporate strategies. Seventh, the overall financial market perspective on medtech is favorable. Many device stocks have outperformed more sluggish pharmaceutical peers recently, as they offer a blend of defensive healthcare stability and tech-like growth. Investors see the device sector's recurring revenue models and the essential nature of many devices as attractive. However, competition is stiff and innovation cycles are fast, so companies must continuously invest in R&D to stay ahead, a dynamic that the market monitors via each firm's product pipeline and patent portfolio. 8. Health tech and AI revolutionizing the sector. Digital health and artificial intelligence are transforming healthcare industry operations, creating new business opportunities and altering competitive dynamics. First, pharmaceutical companies are embracing AI and machine learning to accelerate drug discovery and development, and it's becoming a key theme in the healthcare financial story. For instance, Eli Lilly extended a high-profile partnership with Insilico Medicine, leveraging Insilico's generative AI platform to identify new drug targets and design molecules faster than traditional methods. Moves like this are seen as validating the promise of AI-driven biotech, with industry experts expressing optimism that these tools could shave years and substantial cost off R&D. Second, tech giants are also deeply involved in healthcare through AI. In a significant development, OpenAI introduced a specialized AI model called GPT Rosalind, fine-tuned for biomedical research and named after DNA pioneer Rosalind Franklin. This model is being trialed by big names in pharma and biotech and is capable of interpreting complex scientific literature and suggesting experiments. The entry of such domain-specific AI, alongside major collaborations like Novo Nordisk turning to OpenAI's technology across its business processes, indicates how vital AI has become in the race for efficiency and innovation in healthcare. Third, investors have taken note. heavily backing health tech and digital health initiatives that harness AI to solve healthcare problems. Startups working on everything from AI-powered diagnostic imaging analysis to predictive analytics for patient outcomes have raised substantial funding. The excitement is visible in how some publicly traded healthcare tech firms have seen their stock prices climb in tandem with the AI hype cycle. However, wise voices in the field temper enthusiasm by noting that human expertise remains irreplaceable. AI is a powerful tool, but doctors, scientists, and analysts must guide and validate its outputs, especially in life and death domains. So the prevailing approach is human in the loop to ensure safety and reliability. Fourth, beyond R&D, AI and digital tools are streamlining healthcare administration and patient care. Hospitals and insurers are deploying advanced algorithms to optimize scheduling, predict patient admissions, and detect fraud in billing, which can save significant costs. Meanwhile, in patient-facing tech, digital health platforms are gaining traction. Wearable devices and smartphone apps that monitor health conditions are integrating with healthcare providers. For example, patients with chronic illnesses are increasingly managed through app-based coaching and remote monitoring, improving adherence to medication and diet, and companies offering these solutions often partner with insurers or employers, creating new business models. Fifth, telehealth and virtual care remain fundamental in the digital health landscape. While the explosive growth of telehealth during the pandemic has stabilized, virtual visits have evolved rather than disappeared. Many practices now use a hybrid care approach, some in-person, some virtual, and telemental health especially remains in high demand. Telehealth providers and platform companies have had to adapt their strategies, focusing on integration with traditional healthcare systems for referrals and partnering with insurers to cover services. As a result, the pure-play telehealth companies have seen their stock volatility stabilize and are plotting growth in specialized niches like virtual primary care or chronic disease management. Sixth, data privacy and cybersecurity are crucial as health tech expands. Several high-profile incidents of data breaches in hospitals and digital health apps have kept this issue in headlines. Companies and regulators are doubling down on safeguards, as a major breach can not only harm patients but also erode trust and lead to regulatory fines, directly impacting financials. Investors are increasingly factoring cybersecurity robustness into their valuation of health tech ventures. Seventh, on balance, the convergence of tech and healthcare offers significant long-term growth potential. We're witnessing a structural trend where health companies that successfully integrate AI and digital solutions could achieve better outcomes and efficiency, thus gaining a competitive edge. In turn, technology companies that crack the healthcare market find a huge addressable sector. This cross-pollination is predicted to intensify, and it means traditional healthcare firms might look and behave more like tech firms over time, with valuations to match if they can demonstrate that coveted combination of improved patient outcomes and stronger financial performance. 9. Global market dynamics. China and beyond. Healthcare is increasingly a global game, with international developments in markets like China reshaping the competitive landscape for the industry and its investors. First, China's biotechnology and pharmaceutical sector is rapidly ascending, altering the balance of global healthcare innovation and finance. Chinese biotechs have been expanding swiftly, helped by a streamlined local drug approval process, robust funding, and government incentives. The scale and speed at which China's health sector has grown is startling. Industry experts note that China has become a global leader in clinical trial activity, with some estimates suggesting it conducts more clinical trials than any country except the U.S. The country's regulatory agencies have also become more efficient and globally aligned, making Chinese drug approvals and data more internationally credible. Second, this growth means Chinese healthcare companies are increasingly competing on the world stage. Some are developing novel drugs and launching them domestically first, then aiming for approval in Western markets, a reverse of the historical pattern. Others are forming partnerships with multinational pharma companies or out-licensing their innovations abroad. Global investors are paying attention. Hong Kong and Shanghai have become major hubs for biotech IPOs, channeling international capital into Chinese firms. The result? A two-way exchange. Western companies tie up with Chinese partners to enter China's huge market, while Chinese firms invest overseas or acquire assets to gain technological edge, making healthcare a more globally interwoven industry than ever. Third, emerging markets beyond China are also pivotal for growth. Large pharmaceutical companies are increasingly looking to countries in Asia, Latin America, and Africa as their next frontiers. Factors like favorable demographics, rising middle class, aging populations, and improving healthcare infrastructure mean that emerging markets are contributing a growing share of pharma sales each year. For instance, India is a powerhouse in generic drug manufacturing, and Brazil's healthcare market is expanding with government support. Many multinationals report double-digit growth in emerging economies, offsetting slower expansion in saturated developed markets. Fourth, global public health events can have swift financial repercussions on healthcare markets too. For example, in the event of a regional disease outbreak, like a severe flu or, as recently, an Ebola flare-up, we see vaccines and drug developer stocks jump on speculation of increased demand or funding, while other segments might dip if elective procedures slow in impacted areas. Thankfully, no major pandemic is gripping headlines today as in earlier years, but investors remain attuned to health crises and the rapid repricing that can come with them. Fifth, international policy changes also influence global healthcare finances. In Europe, as mentioned, stricter cost containment measures like joint drug assessments and country collaborations on pricing could reduce how much drug companies can charge, which in turn influences their global pricing strategies. Meanwhile, Japan's periodic drug price cuts and actions by other governments to cap health costs all feed into multinational companies' financial forecasts. Pharmaceutical firms must juggle these varied regulatory regimes. A drug's commercial fate can vary widely country by country, based on local decisions. Sixth, the global nature of supply chains means geopolitical tensions can carry financial risk for healthcare firms. Trade disputes or sanctions could threaten the supply of active pharmaceutical ingredients, APIs, or medical device components, many of which are made in specific countries like China or India. This is why, as we described earlier, governments like the US are pushing for onshoring critical drug manufacturing, a nationalist impulse that could reorder global supply networks and raise costs in the short term. Companies that proactively diversify their supply sources are seen by investors as better hedged against such shocks. Seventh, despite these complexities, the overarching theme is that global integration is driving progress. Knowledge and capital flow across borders. A breakthrough in one country can benefit patients worldwide, and companies can tap talent and innovation internationally. For healthcare investors, it's increasingly important to have a global perspective, watching not only Wall Street, but also developments from Shanghai to Sao Paulo, as they all feed into the rich and evolving tapestry of the healthcare financial sector. 10. Macroeconomic outlook and sector performance. Finally, we turn to the broader market context, how macroeconomic trends and market forces are affecting the healthcare financial sector as a whole. First, healthcare stocks often behave as defensive assets, and that characteristic has been on display. With economic uncertainty still present globally, from questions about growth to geopolitical tensions, many investors have rotated into healthcare companies for their relative stability. After all, people need healthcare in any economy, which gives large health companies steady demand for their products and services. The defensive appeal of healthcare equities has helped the sector hold up even when more cyclical sectors have faltered. Second, however, healthcare also contains growth-oriented elements, and those are sensitive to interest rates. In the period of rising interest rates, the valuations of high-growth, profit-later biotech and health tech firms were hit hard. Now, as it appears central banks' rate hikes have peaked, with some early discussions of eventual rate cuts if inflation cools, investors are slowly returning to growth sectors like biotech, buoying their stock prices as financing conditions ease and future earnings are less discounted. Third, inflation in healthcare itself is a double-edged sword for the sector. Healthcare services inflation has been above general inflation recently, meaning hospitals and providers can sometimes charge more, boosting revenue, but the input costs, wages, drugs, are also up. For insurers, inflation in health costs is a direct hit unless offset by premium increases, as we discussed. So the interplay of inflation requires careful navigation. Encouragingly for the sector, general inflation has been trending down from its peak, which could imply fewer surprises in cost structure and more predictable planning for health companies. Fourth, currency fluctuations are another macro factor impacting multinational healthcare firms. A strong U.S. dollar, for instance, can weigh on the overseas earnings of American pharma giants, as foreign sales translate back to fewer dollars. Many companies hedge some of this risk, but not all. Conversely, if the dollar weakens, it could provide a tailwind by boosting the value of international sales. In the current environment, foreign exchange has been relatively stable compared to the volatile swings of previous years, which has given investors one less thing to worry about in analyzing international health businesses. Fifth, one trend to note. The healthcare sector's market performance in comparison to other sectors has seen some swings. Last year, healthcare underperformed flashy sectors like technology, as megacap tech stocks soared, and some investors took profits out of pharma and insurers. But so far this year, healthcare is making a comeback in line with market averages, with some subsectors, like big pharma and medtech, modestly outperforming due to their solid earnings and safe haven status. Essentially, healthcare is reasserting its role as a core holding in many portfolios, and its lower volatility is attractive as we navigate uncertain economic waters. Sixth, demographic and societal trends continue to underpin the long-term bullish case for healthcare. The population in developed markets is aging, which steadily increases demand for everything from pharmaceuticals to home health services. Emerging middle classes in developing nations are seeking better healthcare, fueling global growth. These secular trends mean that, no matter short-term market gyrations, the overall demand curve for healthcare points upward. Companies poised to meet these needs efficiently stand to benefit tremendously over the coming decades. Seventh, looking forward, analysts maintain a cautiously optimistic outlook on the healthcare financial sector. They cite balanced risks. Policy and political changes remain a wild card, and innovation cycles can be unpredictable, with both breakthrough wins and expensive failures. But on the plus side, strong balance sheets for many companies, a constant need for healthcare, and the sector's demonstrated agility in adapting to challenges, from pandemics to regulation, give confidence that it can weather storms and continue to reward patient investors. The healthcare sector thus remains, in many eyes, a fundamental piece of a robust investment strategy, offering a mix of stability, growth, and ongoing transformation. And that concludes our comprehensive news analysis for today. We've explored a wide range of topics, from pharma breakthroughs and biotech rebounds to policy shifts, insurer strategies, hospital challenges, tech revolutions, and the global and macro forces at play. Each of these developments is weaving together into the ever-evolving tapestry of the healthcare financial sector. Thank you for joining us. Stay informed, and remember, this news is for understanding the market and industry, not for personal advice. Until next time, stay healthy and invest wisely. Video description.